Introduction to Management Accounting. There are two main branches of accounting. Financial and management accounting, we have already discussed some key differences, but let me give you a more detailed comparison. There are three sub-disciplines of accounting: financial, management, and cost accounting. But our concern is between these two. So, financial accounting focuses on external users through preparation of set of financial statements, balance sheet, income statement, cash flow statement, statement of change in equity, and so on and so forth. It is produced with reference to or in accordance to the US GAAP or IFRS reporting standards, and it has historical perspective. It focuses on the past. Whereas management accounting is primarily or principally concerned with internal users, managers, departmental heads. Their focus is to reports to improve organizational decision making, and they have future orientation. Same stuff here. Financial accounting provides information to external users. Financial accounting is focusing toward the past, what has happened, and it is prepared in accordance with the accounting standard, International Accounting Standard Board, IFRS, or the US GAAP. Whereas management accounting is for the internal users. It is for the decision-making purpose, and it has a future orientation, and it is not regulated by any standard at all. There are four broad areas of decision-making that management accounting is specifically used for. First, developing objective and plans for the business, for the departments, segments, performance evaluation of individuals, performance evaluation of divisions, processes, activities, how well they are performing. Allocating resources, the limited resources needs to be allocated amongst various production facilities. And finally, determining the costs and benefits of any endeavor, cost and benefit of any decision. Why is it so important? Plan for the future means management accounting helps businesses forecast future scenarios and prepare accordingly. Strategic options. Management accounting provides various strategies, various approaches to tackle business challenges, how we can manage various problems, how we can benefit from various opportunities that we may come across during our business operations. Then, increase production. Management accounting helps determine the optimal production level. We don't want to produce too more, we can't sell, or we don't want to produce too little that our customers go empty-handed. So we establish an optimal production level to meet the customer's demand efficiently. Next, reduce production. The same thing we discussed. Management accounting helps in deciding when to cut down production to avoid excessive unsold stock of goods. Review past decisions. Yes. Management accounting helps us analyze the outcomes of the previous decisions. What decision did we take and what was the outcome? It will help us understand their impact so that we can make good decisions in the future. Change plans. Management accounting offers the flexibility to modify business plans based on updated financial insight or the changing market conditions. If things change, we can revise things as well. And finally, control. This is a very important part of management accounting. It enables businesses to control their operations. How do we control? Through budgeting, through monitoring, and then comparing our budget with actual performance, and then making any necessary adjustments so that such deviations, such variances do not occur. Cost unit, or a more appropriate term for cost unit, is cost objective. This is a more suitable description of this idea. Cost objective, or simply the cost object. Let me show you what it means. Cost objective or cost object is any entity, not just product only, any entity to which cost is attached. It could be a product. We can attach cost to product, cost of material, labor, overheads. We can attach cost to processes. So process is a cost object. We can attach cost to employees as well. Consider this angry looking old man. Let's say he happens to be our HR manager. So what is the cost of the manager? The salary we pay him, company maintained car, house rent allowance, education supplements for children, fuel. This is so all the cost which is directly attributable to this old man, or the cost that can be attached to him, and this person, this individual is referred to as cost object or cost objective. So we can attach all the costs directly related to him. Cost object can also be a department. Cost object can also be a facility. So any entity to which the costs are assigned is called a cost object or cost objective or cost unit. So the term cost unit is a vital one. I would call it cost object to understand, as if it features heavily throughout the management accounting topics. So a cost unit is a unit of output to which the cost can be charged, or more precisely, a cost object is any entity to which the cost can be attached. So choosing an appropriate cost objective is very important within a business for decision making purpose and for the purpose of cost allocations. So here we have a next point which is appropriately explained here. A well-designed responsibility accounting system establishes responsibility centers within the organization. There are 4 types of responsibility centers: those responsible for costs, revenue, profit, and investment. Let me explain. This is the canteen in a factory. So canteen only incurs cost. It only serves meals to employees at no charge, because food is a part of their remuneration, their compensation, their remuneration. So cost center is a center or a division within an organization that incurs cost only, like maintenance department, like canteen. So it is responsible for cost only. A revenue center is responsible for revenues only. For example, a sales department within an organization. A profit center is responsible for both revenues and costs, hence profits. So a profit center is responsible for profits or the determinants of profit, revenues and expenses. For example, an appliance department in a retail store. An investment center is responsible for all the 3, revenues, costs, as well as invested capital. For example, a branch of a bank. So this was our next point. Managers will have responsibilities at different levels, such as controlling costs, controlling profits, or achieving a return on investment. So here we have described only 3: cost, profit, and return on investment. There is another one, revenue center. So there are 3 responsibility centers. Fine, you may say. A cost center responsible for cost only, profit center responsible for profits, and investment center responsible for cost, profit, as well as invested capital. We have discussed this concept in detail earlier. Next topic, we have cost classification or classification of cost. Consider a manufacturing business. In a manufacturing business, we have a production facility where we use direct material, labor, expenses which can directly be traced in the end product, and the overheads. These are the 4 costs of manufacturing. Out of these 3 are called direct costs because they can directly be traced in the end product, and overheads, they are indirect costs. Let me show you what exactly it means. Okay, consider the cost of manufacturing this computer here. The material is the cost directly identifiable in this product as a material: screen, keyboards, processors, and other electrical circuitry. Direct labor, the labor directly associated with assembling and combining different components of the computer. Then certain direct expenses which are directly traceable to this product. For example, $50 software fee paid to Microsoft, software license fee. So these 3 costs, direct material, direct labor, and direct expenses like software, these direct costs are called prime costs. We'll discuss this idea as we proceed. Then these are direct costs because they are directly identifiable. Then there is a set of costs which are called indirect costs or factory overhead, or sometimes they're called manufacturing overheads. Right? So these factory overheads are of two types: variable overheads and fixed overheads. Variable overhead, they change with the level of production: electricity, gas, water, indirect material, indirect labor. And fixed overhead, these are the overheads that do not change with the level of production, like rent, insurance, property taxes, depreciation, salary of the plant manager, plant supervisor. So these are the costs now we are discussing. So direct material, direct labor, and direct expenses, prime cost. Overheads, also called the manufacturing overhead, they are of two types: variable and fixed, and collectively all these costs are called manufacturing cost. Then from here they move to the warehouse, finished goods warehouse, and then they are sold to the customers, and then this becomes cost of sales. The units of production that we sell to our customers, the cost in those units becomes cost of sales, which is compared with sales to calculate your gross profit. Then other than these costs, we have another set of costs called non-production cost, or sometimes called the non-manufacturing cost, like selling and administration cost. I will show you exactly where. Operating a manufacturing concern, a manufacturing business, requires the incurrence of non-manufacturing costs: selling, marketing expense, and administrative expense. Selling means all the costs related to sales, like sales personnel salaries, advertising, product transportation. And then administrative costs include executive salaries, depreciation of the head office building, depreciation of property, plant, and equipment related to administrative office, and so on. And this distinction is important because these costs become part of the product, cost, and these costs, they do not become part of the product. So these costs are called manufacturing costs, and these costs here are called non-manufacturing costs. It says there are four main ways in which costs can be classified: by elements, by nature, by function, and by behavior. Let us discuss these one by one. Classification of cost by element. For example, materials. All materials used to produce the item becomes the material cost. Labor cost. All wages and labor related cost becomes labor cost. And then expenses like rent, rates, telephone, insurance. So these three categories are often referred to as the three elements of cost and can provide vital information. Let us discuss further. So within each of the three elements of cost, some can be identified directly with the unit of product, which we call the direct cost, like direct material, direct labor, direct expenses. We just discussed a little ago. Such costs are called prime costs, right? And the indirect costs are the costs which cannot be directly identified. Direct material can be identified. Direct labor, we have the records we can identify. Direct expense like software licensing fee. So these costs which are directly traceable, identifiable to end product, are called prime costs. And the costs that are not directly traceable, indirect material, indirect labor, factory operating costs like rent, insurance, etc., all these are called collectively as indirect costs or manufacturing overhead costs. Like direct material is the cost of raw material used directly to make a product. That is direct material. But indirect material like cleaning material we use to clean the factory floor, factory lavatories, for example. Similarly, then we have direct labor and indirect labor. Direct labor is the labor that works directly in the production line. Indirect labor is like managers or like janitorial staff, those who are responsible for custodial services. So these are called indirect labor. Similarly, expenses can also be direct and indirect. A direct expense that is directly identifiable, for example, licensing for software on a laptop, is a direct expense. And all the other expenses which are not directly traceable in the product are called indirect, right? So these costs that you see on the middle are called prime costs because they are directly identifiable and all others are indirect. Then we have cost classification by functions. There are many sections within an organization like production cost, the cost related to production. Administration department, its cost. Selling and distribution cost. Finance department or finance function. So this classification can also be used by non-manufacturing organizations like hospital, universities, banks, and so on and so forth. Then classification by cost behavior. The cost that doesn't change with the level of output is called fixed costs. Rent, insurance, taxes, salaries of the executive, salary of the production manager, they are fixed. Semi-variable costs or semi-variable costs, these are the costs that are composed of two components, partly fixed, partly variable. For example, electricity bill, or let's say telephone bill, it has a certain standing charge, let's say $200, and then every call you make, let's say, costs you $1.50 per call. So this part is fixed and the remaining part is variable, depends upon your usage. And variable cost, as the name suggests, it varies with the level of output. You produce more, you spend more direct material in production. You produce more, you spend more direct labor cost, more electricity, more water, and so on. So how these costs are classified depend upon what type of business you are in or what information is required. So the costs stay the same. Cost is cost, no matter from which aspect do we classify. So classifications may vary, classification by function, by nature, but the cost in total stay the same. That's the idea. The costs themselves are exactly the same, irrespective of how they are classified. Classification is not mutually exclusive. Classification is not mutually exclusive. Like, for example, we have direct material, direct labor, and direct expenses. This is called prime cost. Then there is another set of costs called conversion cost. Conversion cost is the cost required or incurred to convert the material into finished goods. And it consists of direct labor, direct expenses, and the manufacturing overhead called the indirect expenses. So what you see here is that this part is common. Direct labor and direct expenses fall on both sides. So that's what it says. Classification is not mutually exclusive. So cost can be classified in more than one way. That's the idea. Calculating the cost of a unit. It is a very important number because once you know the cost per unit, let's say I make a certain item and it costs me $10. Based upon this cost information, I can set a selling price. That's what it says. Once you know the cost, selling price can be determined, clearly a price above the cost so that you can make some decent profit, $5 per unit, for example. So it is important to establish the number of units of output for a particular period. Like, for example, in a particular quarter, we produce 10,000 units and the total manufacturing cost inclusive of material, labor, indirect cost is $150,000, let's say. So that means our unit cost would be $15 per unit, and then we can set the selling price accordingly. So it is important to establish the number of units of output for a particular period. This will help us calculate per unit cost. Once this is known, the direct cost can be established, and then we can also add up the indirect cost and develop our unit cost just like the way I've calculated. All the direct and indirect costs combined, 150,000 units, divided by the number of units produced, 10,000 gives you per unit cost of $15 or £15 per unit. And this is the cost statement. We have direct material, part of production cost, direct labor, part of production cost, direct expenses like royalties, licensings. This set of costs is called prime cost, right here. To this we add production overheads, which can be fixed and variable. Adding this gives us the total production cost. To this point, all the costs are incurred in factory. And then once it's made, we have the cost called non-manufacturing cost, that is the selling and distribution cost, administrative cost, finance cost, which is basically borrowing cost or interest charges.